You probably paid your taxes last year, right? Every single dollar, right on time, exactly like they taught you to do. But there is a whole other reality out there. Welcome to this explainer, where we're going to dive into the completely different set of rules that the ultra-wealthy use to legally pay absolutely zero taxes on their massive wealth. Think about this for a second. While you're making sure your taxes are filed on time every year, billionaires like Elon Musk, Jeff Bezos, and George Soros have legally paid exactly zero federal income tax in certain years. Seriously, zero. Elon Musk paid zero in 2018. Jeff Bezos paid zero in 2007 and 2011. And George Soros? He paid zero for 3 consecutive years. It sounds completely impossible, but it happens all the time. Now, I know what you might be thinking. You're thinking, they've got to be cheating. But actually, let's clear this up right now. This isn't about tax fraud, and it definitely isn't illegal. We're talking about a completely different set of rules. It's a parallel tax system that they absolutely never taught you in school, and understanding it is the key to seeing how wealth actually operates in the real world. Let's start with Section 1, the 2 tax systems. Here's the uncomfortable truth about our financial structure. America effectively operates on 2 completely different tax systems, and which one you fall under depends entirely on how you make your money. Basically, one rulebook is for people who earn money by working, and the other is for people who earn money by owning. If you work a traditional job and earn a salary, the government can take up to 37% for federal taxes, plus state taxes, plus payroll taxes, before you even see your paycheck. It gets sliced and diced before it even hits your bank account. But passive income, if you own assets that grow in value, you pay absolutely nothing until you sell. And here is the ultimate secret. The wealthy simply do not sell. Instead of selling, they follow an exact step-by-step formula. Step 1, buy growing assets and just watch them appreciate. Step 2, borrow against those assets at very low interest rates and live off that loan. Why? Because the IRS does not consider a loan to be taxable income. And step 3, die and pass those assets to heirs with a massive built-in tax advantage. So the absolutely crucial point here is understanding this concept of buy, borrow, die. I know it sounds a little morbid, but it's the exact legal strategy that keeps the wealthy from ever paying income tax on their growing wealth. You buy assets, you borrow against them to fund your lifestyle completely tax-free, and you eventually pass it all on to permanently eliminate the capital gains tax. It literally operates as an endless cycle of wealth preservation. Moving on to Section 2. The 70,000-page problem. You see, this goes much deeper than just one simple strategy. It is deeply rooted in the actual design of our sprawling 70,000-page tax code. And guess what? Nearly every loophole in there has been influenced by wealthy donors. When you look at how the system is deliberately designed, the contrast is just stark. The middle class is locked into a really rigid system. Labor is heavily taxed, you're mostly limited to a standard deduction, and you rely on a W-2 form that tells the government exactly what you owe before you even sit down to file. Meanwhile, ownership is heavily rewarded with customized loopholes and advisor-managed reporting. The middle class is essentially trapped. You earn too much to qualify for relief, but too little to easily access these elite strategies, which means you end up paying the maximum possible tax rate at every single level. Which brings us to Section 3, 5 legal tax strategies. Now, here's the good news. Ordinary people actually have access to many of these ownership strategies starting today. You don't need to be a billionaire, you just need the right roadmap. Strategy 1 is shifting from earned income to passive income, because the exact same dollar is treated radically differently based on where it comes from. It can be taxed up to 37% if it's your salary, but it's capped at a maximum of 20% if it's long-term capital gains. And if it's borrowed cash against your assets, like we talked about, that's taxed at 0%. So the primary goal is to own things that generate income, rather than just working harder and harder for a bigger paycheck. Strategies 2 and 4 are all about leveraging real estate and owning a business. Think about it. Employees pay tax on almost every dollar they earn before they spend anything. But business owners, they get to deduct their expenses first, things like a home office, travel, equipment, software, and then they're only taxed on whatever profit is left over. Furthermore, real estate investors use a legal mechanism called depreciation to create a paper loss, legally shielding their rental income. It completely and permanently changes your tax position. Strategy 3 is maximizing tax-advantaged accounts. And we're talking about the legal shelters that are available to almost everyone right now. Your 401k, your IRA, your health savings account, and a 529 plan for education. Most people dramatically underuse these. By maxing out these accounts in the right order, you are ensuring that every dollar inside them is allowed to grow completely tax-free or tax-deferred. It's a massive advantage over time. And finally, strategy 5, the stepped-up basis strategy. This one is incredibly powerful. Let's say you buy an asset for $100,000 and it grows over decades to $1 million. Normally, selling it means you'd pay taxes on that $900,000 gain. But if that asset is passed to your heirs at death, the tax code allows the cost basis to step up or reset to the current market value. That means those decades of gains are legally eliminated overnight. Poof, gone. It is the ultimate wealth preservation tool. All of this brings us to a massive mindset shift. If there's one thing to take away from this, it's this. Stop thinking like an employee and start thinking like an owner. The fundamental shift here isn't about suddenly having millions of dollars in the bank tomorrow. It's about shifting your approach right now so you can apply these rules at your current income level. It's about focusing on acquiring assets, managing your deductions, and prioritizing tax-advantaged growth. You know, exactly like the ultra-wealthy do. Which leaves us with this final, critical question. Now that you know the rules, which game are you actually playing? The wealthy don't avoid taxes by cheating. They avoid taxes because they simply received a different financial education and learned to navigate the tax code. The only difference between paying 37% and paying almost nothing is knowing which game you are playing. Thank you so much for joining me on this explainer, and I really hope this helps you completely change how you look at the rules of the game.